Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets, and it's a good time to look back not only on a week, but on a quarter here as we start a new quarter, and then give you sort of an update on the present time.
We did start a new quarter.
We did start a new quarter.
It is that time.
Yeah, let's wrap up the quarter and then give everybody a little bit of an update of where we are today on October 4th as we record, to be released on the 5th. So yeah, a lot of action here, a lot of activity since the last show. A couple of weeks ago, you and Rob and I were all talking about this possibility of coming down to test that first 50% Fibonacci retracement level. And man, we just kind of blew right through it down to the 618. So that's where I passed the baton to the chart master, Miles, here today, and take it from here.
Yeah, it's football season, Tori, and sometimes a running back finds a hole.
There you go.
That's what we've seen happen. Yeah, most of your major markets are obviously down. You know, stock market's getting shellacked.
You must not be talking about the Broncos, because no running back can find a hole on the Broncos offensive line.
No one's going to waste their time watching the Broncos.
So, all right, sorry to interrupt.
Nobody going. Outside of this office. Nature of being a Colorado company, we have to suffer every year through the football season. What were we talking about? Gold pricing. So getting back to gold, yeah, most of your major markets are just getting crushed right now. The dollar's been super strong. How long have we been waiting for an actual retracement in the gold price? And I know the problem is you look at the length of time from when gold started and when gold peaked, which wasn't that long ago. We're still talking about the highest price in history on the futures market just back in May. It's a multi-year move, $500-600. And we've been waiting for this pullback for a while. So I think the problem is we all got kind of lulled to sleep. The gold market did. Like the retracement that we're seeing in the price of gold right now is closing in on a 618 retracement on a relatively short final leg of the gold price, which started back in like November of last year, down around 1640, up to just shy of 2100, I think 2083, 2085 on the futures market. So we're finally coming back down towards that 618 level in the gold price while we're watching silver come down, while we're watching the stock market get kind of crushed.
Yeah, and today's an exception. We finally have seen just a little bit of green, meaning up in the gold price. It's kind of held in there, although we did retest. We've now put in two lows yesterday and today, right around the $1,815 mark. Why are we bouncing off that, or why have we bounced off that twice, do you think?
The best I can come up with, fibs are kind of an arbitrary thing, which is why I always like to talk about Fibonacci levels being in a range, because there are a couple different ways that you can view it. So I've got my personal fibs down more around like 1805, so we're not quite there yet. So I would say the best I can do is look back at, say, okay, what was occurring at this price level last time we were here? And what this was is we had just put in, if you look at the gold movement going from November until May, we had a move up, we had a little bit of a correction back down, and then we took another nice big leg up. So 2 steps forward, 1 step back, and then we completed that move up. And then we've spent the last number of months since May kind of figuring out when are we going to come back down and actually see a real bigger correction. So if you look back to that pricing back in like February and March, before we took that final leg up, you did have a couple little bottoms put in here, and that's kind of where we're seeing that price play around at right now. So I would argue you're just looking at people that probably placed orders there, or even might even still have standing purchase orders from 6 months ago that are now starting to bump into some stop losses. So that's going to bring automatic trading coming into the market, and you're going to see positions get filled. You're going to see stop losses get filled, and that's going to kind of slow down the market a little bit there.
Well, so in last week on the show, we talked about silver hadn't really broken out of its channel. So you threw up a really pretty pattern and how
sure
silver
has
had held.
Now.
Man, I mean, it was less than 24 hours later that it finally broke out to the downside. That being said, the ratio too has gone from about 83 to 87. We saw it as high as 89 for just a brief period of time. So what are you seeing now? I mean, we have to kind of redraw the lines on the silver chart too.
Yeah, to some extent. I mean, that channel's obviously broken. I think it's very reasonable. Let's say we're looking at a normal trading pattern. Generally, when you break a channel, you come back up to retest that channel, and that would set your sort of ceiling for whatever the next market trading range is going to be.
A new resistance level.
Exactly. So what I'd be looking for is some type of reversal, probably coming in the metals here. And this brings up something you and I were talking a second ago that I think leads into it. Gold and silver have both declined very quickly in a very short period of time. So when you start looking at some relative value indicators, like say the MACD, the moving average convergence divergence, which is measuring a moving average price of a certain, in this case, gold or silver, and how much it transitions towards or away from that number over time. That MACD is significantly oversold, way down at the bottom. RSI, the relative strength index, same story, significantly oversold and going to start climbing because it has to. It can't go below zero. That's not how the math works. So what I think we might actually end up seeing here is something that I bring up occasionally. It's called divergence, where you have a major indicator moving one direction, but the price is moving the opposite. That usually happens at the end of a market move, where in this case, let's say gold takes a couple little stair steps down, maybe it gets down to my 1805, maybe it gets down to 1795. But perhaps we see gold take a couple tiny little stair steps down while RSI, while MACD, while some other indicators are going to start climbing up from the basement. And that usually signals that the market move has just exhausted itself, and we're going to see a little bit of a correction back the other direction. As we see that correction, that'll tell us, are we going to continue the long-term trend, or are we putting in, like you said a second ago, that next resistance?
And so we're going to throw this image up here of this chart on gold, which is a little bit different because we are going to show the MACD and the RSI that you talk about. The other thing I want to point out to the listener is look at the separation from the 50-day moving average. Anytime we see this to the upside, you'll see the exact opposite pattern that you're just describing. Well, same pattern, but in a bullish run instead of a bearish run.
Yeah, it happens on both sides.
It happens on both sides, right? So that's what we see happening when it overshoots to the upside. It needs to pause. It needs to take a breather. It gets overbought instead of oversold. And so these are really fascinating charts to look at today because to me it's encouraging to think we should at least see a pause here soon. That's coinciding with the US dollar index. You started early on by saying, we've seen this huge dollar rally. Yes, the US dollar index did cross the 107 threshold, and we've, as a result, seen not only the gold price get major headwinds due to dollar strength, same thing with the equities. So we'll talk about that in a little bit too. But the other major headwind are bond yields. So as the bond yields that you put up there last week are telling that story, remember that too. A lot of times I'm getting called by clients saying, inflation is still high. Why is gold going down? In my quarterly letter to my clients, I'm talking about, look, this is a tug of war. Legitimately, you've got bulls and bears pulling on that golden rope in a sense. And right now the bears just happen to be pulling a little bit stronger. That's going to change at some point. So look at these opportunities as really good chances to step in. Let's get back to the equities markets. I mean, nobody's talking about the fact that we've seen a 5% correction essentially in the Dow Jones Industrial just in a short matter of 2 weeks, the same action we've seen in gold.
Well, and I think it's 7 if you step back another week or two beyond that, back to where it hit that high. So yeah, just like gold, just like silver, everything's down about the same percentage. And as we're moving into equities, since you brought it up with the dollar, I think the dollar is continuing to lead on the other side of some of these other assets. And we're starting to see that divergent pattern show up in the dollar as of this week. So the dollar may be a week ahead of gold, of silver, of the Dow, and we may see that same thing play out in the dollar. So looking over at the Dow is really a long way to go before you argue bearish, obviously. Now,
well, a technical bearish really isn't until a 20% retracement.
True.
So
yeah, that's definitely one of the arguments, which we did. Now, and here's another argument.
Last year?
Yeah. And why that may still hold water is because we just tried to get back to the old highs and failed. So the 20% decline, the 20 plus percent decline, and even more in the NASDAQ, which was what, 30 some?
Right.
So in the tech sector. So this 20 plus percent decline we saw in the S&P and the Dow, that hasn't gone away yet. That hasn't been erased off the chalkboard.
Hasn't been satisfied in a sense is what
No.
yeah.
So, and here's my fear with that. We saw a similar pattern going back a year. You see this significant decline. It leads into the same kind of divergent pattern. Divergence in a chart does not mean trend correction or trend change. It just means you're going to have a blow-off period. So it's very possible all the growth that we've seen, all this kind of corrective growth that we've seen back in the Dow, and in the fact that it failed to put back in or at least get back up to the old highs, we may very likely still be in the same bearish pattern that we kicked off over a year ago. And this is just that first little attempt to prove it wrong before it does completely fail. And if you go back to 2008, the exact same thing happened. We had a decline. We tried to get back up to the same numbers, failed, and then the actual crash came not too far behind.
Yeah, and you're seeing a real similar pattern here. Again, we'll put up a similar chart here just on the equities showing that same pattern and that separation from the 50-day and 200-day moving averages. And the whole reason for showing those is that at some point you come back to touch those averages. It's going to happen.
Oh, yeah.
So when you get a huge separation to the downside or to the upside, just know that that's unsustainable. It doesn't mean that you've exhausted it. It just means that at some point you come back to it. Again, that's encouragement. We are seeing gold and the Dow move the same direction right now, and that is counter to the U.S. dollar. That is common. But 72% of the time, roughly, there's a non-correlation or an inverse correlation between equities and gold. So what happens is if you're right and the stock market really does see that further decline back into bearish territory, you should likely see gold start to reverse. The longer it gets drawn out, just like last year, the more gold will start to rally and precede any sort of market correction in the equity. So it's not a perfect recipe, but again, just speaking about, is this a good buying opportunity? For three reasons. One, the uncertainties continue and the negative numbers continue to pour in economically. Two, you've got this huge separation from the moving averages. And three, you've got the oversold positions. Well, and really four, you're down at a technical support level that you've been talking about. So to me, yes, absolutely worth a cost average in position.
So yesterday I got an email from a outside financial advisor that we've worked with for a number of years asking a couple questions. And I started doing a little bit of research for him and sent him an email back that was probably way too long, longer than it should have been. But he was asking about global demand. So I went to the World Gold Council website and I started doing a little bit of research because I know the numbers are up, but I wanted to see if there was any good data. So here's what I learned yesterday. 2022 global demand for gold is the second highest in 15 years, barely behind 2011. 2011 was the blow-off top in gold. That was the highest, most frantic the gold price had ever been in 50 years, 40 years at least since the late 70s, maybe longer. Last year was almost that big. Last year is not a blow-off top in gold because we hit a higher price this year. Mm-hmm. So it makes me really nervous to see what's coming. On top of that, central bank buying, biggest it's ever been last year.
Yes.
Central bank buying first half of this year, biggest first half ever.
Yep, bigger than 2022.
We could end up having back-to-back largest central bank buying in the history of our planet, while they're also telling us gold is a dead relic and you should definitely be considering the value of the U.S. central bank digital whatever that's called.
Yeah, go buy some Japanese yen then.
Yeah, the same people that are pushing the narrative of U.S. what's it called? CBDC, central bank digital currency. Same people pushing that narrative are buying the largest quantities of gold those central banks ever have. So yeah, go buy some Japanese yen. Tell me how that's working out for you.
Yeah, I mean, you are getting some swings. I'm sure Forex trading is very fun right now, but the British pound just had its worst month for a year. The yen, was at its weakest level in a year, that's your dollar index rally right there. That's also not going to last necessarily. So don't put too much emphasis on this dollar rally. It's not like we've done suddenly some strong dollar policy. And in fact, the opposite. Yeah, did we pause in our interest rates? We did, but that's not strong dollar policy. Rising interest rates are actually strong dollar policy in a sense. But, the U.S. added $275 billion in debt in one day. So now total U.S. debt is $33.4 trillion. 2 weeks ago, we had just hit $33 trillion. So now we're on pace to add $1 trillion in debt in 1 month. Therein lies the problem. That's money creation. That's a depreciating dollar. And that is why it is baked in to the cake, Miles, that the gold price will double.
Do you remember, how long have we been doing this? 6 years now? 5, 6 years? So right when we started doing this show, I remember when they were talking about inflating to $85 billion a month. And we could not believe that number.
Yeah, we couldn't believe 20 trillion in debt.
Right. 85 billion a month was astronomical at the time, and now it's, what'd you say, 285 in one day?
In one day.
There you go.
And on pace to do $1 trillion
Why
in a month.
not?
Yeah.
It's your grandkids' problem.
Well, and unfortunately, that's linked to a lot of other issues, right? There's a domino effect going on here that's going to affect the banking sector greatly, in my opinion. You talk about some past glimpses on some warning signs. To me, the bank failures early in the year were just like that. Well, they've continued to raise rates. I think the reason that they've paused is sheer pressure from the Wall Street banks and Main Street banks. I mean, the banking sector in general, they're the ones that are going to get left holding the bag as commercial real estate declines. I mean, go again, look at this chart on DRV, the inverse ETF on the real estate sector. Big money knows that real estate is already rolling over. Right. Now, couple that with slowing credit markets. People aren't borrowing. Banks aren't wanting to lend. There's a distrust in the system. The Federal Reserve wanted a recession. They got one. Unemployment numbers now are driving higher. If you look at John Williams' shadow government stats, the real unemployment rate, if you factor in the long-term discouraged worker, 25.2%. And they're trying to say we're at max employment. They're now trying to get wages to shrink, which wage growth now has shrunk for the first time in 29 months. So they're getting their recession. Unfortunately, they're doing that on top of spending and interest rates climbing. And Mason Stetler of Vaulted drew some great charts. And I'm going to throw this up here and just show you that the outstanding marketable government debt now that's going to mature by 2026 is $14 trillion. So here we are adding $1 trillion in 1 month. But we have debt maturing to the level of $14 trillion by the end of 2026.
Yeah.
And that doesn't include the new debt that will be added in those 3 years. Like
and
they're going to do 1 year.
What interest rate is that going to get rolled into?
Exactly. Again, that bakes in the cake that we have higher rates for longer. That is higher interest rates. And I'm sure this is going to be heavily utilized on the McIlvaney Weekly Commentary as a talking point for why gold, again, will just double.
Even for us, right? Like going from 3.5% to 7% on, say, a mortgage hurts. But that's a doubling. Like we're talking about government debt that's probably sitting on the books at between 0 and 0.25%, going to 2.5%.
Great point. It's at 2.5%. We're talking about it going to 4%.
Yeah.
Think about that and its impact. I mean, it's not just GDP, it's the debt service.
Let's give them the benefit of the doubt. Let's say it's 0.5%. That's still an 8-fold increase in interest payment expense.
Yeah. Suddenly it's a third of your economy.
It's enormous.
Yep. So the horizon, to me, has a golden hue.
So that's going to do it this week for Golden Rule Radio. Thanks again for joining us. If you liked what you heard, you can do the YouTube button pushing stuff. Swing by our website at McIlvaney.com. Find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. Better yet, why not give one of us a buzz and speak with an advisor here at McIlvaney Precious Metals to discuss your personal portfolio. Thanks for listening and have a great week.